CVS Health Corporation, stock ticker CVS, is trading right at its 52-week low. It's currently trading at $62.42, and over the past year, it's down about 27.36%, and over the past 6 months, down over 30%. So at its current trading price, is it a stock we should consider adding to our portfolio? Let's go ahead and dig into some of the metrics. If we look at the starting dividend yield, we can see the company does have a pretty decent starting yield, sitting at about 3.5%. Let's go ahead and jump into those dividend metrics a little bit more. Now, if we look at the dividend history for the company, one of the things you'll notice is it has increased its dividends by a decent amount over the past decade, but it did have around a 4 to 5 year period where those dividend payouts stagnated, and it didn't increase any from 2017 to 2021. But if we jump over to the dividend growth tab, overall you can still see over the past decade compounded annual growth rate of about 11.5%. So that's still pretty decent dividend growth, but again, it did stagnate for a while there. You can see the 3-year compounded dividend growth rate sitting a little bit below 5%. Now, with all of that being said, we need to jump into my stock valuation spreadsheet to see if we can find the fair value for this company and decide if it's a good stock to be buying at its current trading price. And we'll be looking at a few different valuation models like always. So let's go ahead and jump over to my stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in the stock ticker CVS and hit enter. And you can see all this data is going to automatically load in. Like I already mentioned, starting dividend yield sitting at around 3.5%. Now the payout ratio on our spreadsheet is showing it around 73.4%. So let's go ahead and dig into that a little bit more because that's a little bit higher than I typically like to see it. So if we jump back over to Seeking Alpha and go to dividends and click on dividend safety again, you'll see that dividend payout ratio for the trailing 12 months, 76%, pretty close to what we saw on the spreadsheet. So that is the dividend payout ratio for the generally accepted accounting principles for trailing 12 months. That's your typical payout ratio that most people look at. What I think is a lot better to look at a lot of the time is going to be that cash flow payout ratio. I think this one is equally, if not more important than your typical payout ratio. And you can see the cash flow payout ratio is actually only sitting at around 25%. So the payout ratio when looking at earnings is definitely higher than I typically like to see it. I still think the dividend is safer than a lot of people realize when you look at that cash flow payout ratio. Jumping back over to our spreadsheet, you can see analysts currently have a target price of $100 per share, so quite a bit higher than that current trading price. And there's a beta of 0.62, so you should see very, very low levels of volatility with this company. Now let's go ahead and look at our valuations, and the first we'll look at is Graham's valuation, a valuation model invented by Benjamin Graham to calculate intrinsic value. And the first thing we need is our earnings per share, and in this scenario I'm actually using the forward-looking earnings per share for CVS, which is sitting at around 8 for most analysts. We then apply our growth rate projection, which for CVS, actually there's quite a few different growth rate projections when you look at analyst projections, but I'm sitting kind of with the median sitting at around 3.75. We then take all these numbers and divide by Y, which is the current yield on AAA corporate bonds, and at the time of this video, it's sitting at 4.56, a little bit higher than it typically sits at, which is going to drive this valuation down a bit. But even then, we still come to an intrinsic value of around $83 per share, which is a decent bit higher than that current trading price. Now, the next valuation model we will look at is the discounted cash flow analysis. So what I do is I plug in the historical free cash flows so we can see those year-over-year free cash flow growth rates, and it's had an average growth rate of around 14.38. But the free cash flow growth rates have fluctuated quite a bit, as you can see right here. Now, this is interesting. You can see I'm projecting a growth rate of -2%. But if we come over here, I made a little bit of a note. -2% for the next 3 years, and then 0 for 2025 moving forward. So basically what I'm saying is I'm projecting a free cash flow growth rate of -2 for the next 3 years, and after that, I think it's going to be around 0. So this free cash flow growth is going to stagnate. So I think this is a company that's really hard to project the future free cash flow for, because a lot of people for CVS are projecting that the free cash flow will be a little bit lower for the next couple of years, and then it's going to kind of stagnate and stay steady moving forward after that. So basically you can see that note again, -2% for the next 3 years and then 0 for 2025 moving forward. So once I've done that, I take the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, which has actually increased a little bit over the past half year, and their total debt has decreased a little bit over the past couple of months as well. So once we get that, we get the equity value, divide by our shares outstanding, and we come to a discounted cash flow price per share of $92.81, again higher than that current trading price. Now the next valuation model that I usually like to look at is the multiples valuation. You can see I have a couple of comparable companies, and I know what most of you are thinking right now. Walgreens is not currently included in the multiples valuation, and you're right. Let's go ahead and put it in here and look at this and look at why. The current earnings per share for Walgreens is sitting at -3.64. But even if we take Walgreens forward-looking earnings per share at 4.5, we'll come over here and plug this in, 4.5. you can still see the price to earnings multiple sitting at around 7. I don't think Walgreens in this scenario makes a good comparison for CVS for a couple of different reasons that I'm not going to dig into too much in this video, but essentially there's such low growth projected for Walgreens, again, negative growth projected for this company, that I don't think it really makes it a very good comparable. So I'm not actually going to use it in this scenario, which some of you may disagree, but I think it's wise in this situation. But then we come to an average price to earnings of 19.65, multiply that CVS's earnings per share, which is the current earnings per share, which is sitting at around 3.03, and we come to an intrinsic value of actually just around $60 per share. Now, the last valuation model we are going to look at is going to be the dividend discount model. So what I do is I plug in the historical dividend payouts for this company so we can see how much they pay out each year, and this allows us to see our year-over-year dividend growth rate. So again, a few years with no dividend growth, but as of late, we can see dividend growth of around 10% over the past couple of years. So moving forward, I'm projecting a dividend growth rate of 3.5%, discount rate of 8.5%, and that gives us a dividend discount model price per share of $50.09. Now, anytime you're projecting a growth rate with a dividend discount model, there's two things you do want to check, and that's for future free cash flow growth. And we really don't have a whole lot of that in this situation, but because the free cash flow payout ratio, like we saw earlier, is so low, we'll go ahead and jump back over and look at that. Right here, I think for a very long time they would still have the ability to increase the amount they pay out in dividends. Let's go ahead and jump back over to our spreadsheet, and we'll jump over to our output tab, and you can see our 4 valuation models. Now, I actually did not include the multiples valuation model in this scenario just because I think Walgreens is still the best one to look at in this scenario. It's the best comparable, but in this situation, it just doesn't make sense to use. And these companies are decent comparables, but it's just still very different than CVS. So again, I'm not using the multiples valuation in this scenario. I'm using grams, discounted cash flow, and then the dividend discount model, which is actually quite a bit lower than our other 2 valuations, as you can see right here. But when we average these 3 together, we come to an intrinsic value of $75.30. So with a 10% margin of safety, you can see our acceptable buy price sitting at around $67.77, meaning it's not quite within our buy range, but it is starting to get pretty close. So I know a lot of people are interested in CVS because the share price has come down so much over the past year and over the past 6 months, has a nice starting dividend yield like we saw sitting at around 3.5% and decent dividend growth over the past couple of years, but there's still really low levels of growth projected for the company, for the free cash flow, and for the earnings. And anytime I see that, that is a little bit of a red flag, and it makes me very hesitant to add this company to my personal dividend portfolio. If they can prove to investors that our growth rate projections are too low, then we could see a really nice value play right here with a nice starting dividend yield, but I'm not convinced that's the case as of now. So there you go. There's a quick analysis on CVS. Go ahead and let me know what you think of this company in the comments down below. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.